The number one thing that blindsides almost every client that I sit down with, it's not return, it's not a stock or an investment that they owned or that they wanted to own and didn't. Almost every client that I sit down with in their early 60s operated under one assumption. And that assumption was taxes were going to be lower when they retired. And they are blindsided when they found out that they weren't. Hi, I'm Will Hoffman, founder and president of Hoffman Wealth Management, and this is Pre-Retirement Navigated, a podcast dedicated solely to the 5 years leading up to retirement. In the first two episodes, we talked about the big things that flipped leading up to retirement and then what you should be doing in year 5 years away from retirement. Today, we're going to be talking about what you should be doing 4 years away from retirement and the decisions that you make here and in year 5, how the decisions that you make in the 5 years leading up to retirement can help lay the groundwork for a successful retirement and one that operates with you in control, but with the flexibility to weather any decisions that are necessary into retirement and anything that can be going on, any things that change once you've already retired and that paycheck stopped. Today, we're going to talk about something I learned very early on in my career. I'm really surprised it doesn't get talked about more. It was how during my training program, they taught us to look at a retirement. And they taught us to look at a retirement and a nest egg using what's called the tax control triangle. And it's very simple to understand, but it's where a lot of folks don't do a lot of advanced planning because they have operated under the assumption the taxes are always going to be lower when they retire. And that may be true for a little bit of your retirement, but once you get into the RMD stage, it's hard to control. It's hard to control your income and hard to control your tax brackets. So the tax control triangle is how we communicate with our clients that this is a very easy way to understand where your assets lie and what the taxability of them are, because starting in year 4 and into the early stages of your retirement, it's where some changes can be made so that you're not at the mercy of RMDs and an uncontrollable tax situation deep into retirement. So just real quick, the way the tax control triangle operates, and you can see a more detailed video on our YouTube channel under the Pre-Retirement Navigated video series. But the way this operates is think of 3 different corners of the triangle. In one corner, you have things that are taxable now, and that is your brokerage account. That is maybe real estate that you own. Everything in there has a taxable consequence to it. Dividend gets taxed, capital gains to get taxed. Everything in there is taxable when it comes to a transaction. In another corner, you have everything that is 100% taxable upon removal from that corner. That's where your IRA and traditional 401k lie. Traditional 403b. A stat as I was getting ready for this podcast that I found, IRAs in the United States in 2025 held $19.2 trillion in assets. That is trillion with a T. Just so you understand that would be the 3rd largest economy in the world as ranked by gross domestic product. America's number 1 at 37 trillion. China is number 2 at about 25 trillion. And the 3rd largest economy on the globe would be the amount of money that is held in assets in the year 2025. That was 39% of all U.S. retirement market assets. And 20 years ago, it was 24%. Now, we've had some nice market returns, had a lot more additional savings. 39%, almost 40% of all U.S. retirement assets are in retirement accounts. It's the most common type of retirement account held by U.S. households at 33%, and most of that money's never been taxed. Now, that's a stat from the Investment Company Institute in an article when they talk about the role of IRAs in U.S. households, but $19.2 trillion sitting in one corner waiting to be taxed. And I can just see Uncle Sam wringing his hands, ready to tax $19.2 trillion. So that's what sits in this bottom corner, along with your brokerage accounts on one side. On the other side, you have all of your assets that are waiting to be taxed, and not just waiting to be taxed, waiting to be taxed at your income tax bracket. Okay. And at the top are tax-free assets. These are your Roth IRAs, your Roth 401ks or 403bs. You also have some things up there. We're not going to talk about it in this episode. We're not going to talk about it much, but folks will say the cash value of life insurance can sit up there. But Roth IRAs sit in that top corner, money that you've already paid taxes on, that is growth tax defer. And for the most part, if you follow the rules of a Roth IRA, that money comes out tax-free. So this is the time to understand what your tax control triangle looks like and what decisions you need to be making, what path you need to be making, and how you're going to navigate the tax scenario, because it can be very expensive. $19.2 trillion. Uncle Sam's a partial beneficiary of all of that money. Not your kids, not the charities that you choose. Uncle Sam. 85 million people that you've never met are the beneficiary of that money if you continue to not acknowledge this triangle and understand what's going on there. So today we're going to talk about that. We're going to talk about some other things that you can start doing in year 4 to tee yourself up for a good retirement and for a flexible retirement, and one that is free from big decisions because you've already made them. We do all this using our navigation formula, and that's the process we use at Hoffman Wealth Management. The best way to think of this is a financial GPS that is helping you get from where you are to where you would like to be financially. It's a process that we use for all of our financial planning so that you get to have a retirement that gives you room to change your mind and that you can actually enjoy. So just a quick note before we get too much deeper into this. Everything we're talking about here is general financial knowledge. This is not specific to your scenario. That's what our navigation formula is. So if you have questions about anything we discuss, your tax advisor or your financial advisor are the best folks to turn to. If you don't have those folks in your life, there's going to be a link in the show notes that allows you to just reach out to us, set up a free 30-minute discovery call to see if our process is something that you would enjoy going through and that could help you. I'm pretty confident that it is. So you can click down there if you have any other questions that you would like to talk about. It's just a conversation. It is a no obligation process. So if you don't like what we have to say, we can part as friends, and I think that's more than fair. The big flip that we talked about in the last episode in this year is that you are starting to flip from accumulation, which in my opinion is easy. You earn, you save more than you spend, you invest, and really the best thing you do during that time frame is nothing. You don't read the newspaper, you don't let those headlines affect you, you don't let big decisions deter you from your goals. And now we're starting to set up a way and what happens when it's time to flip to spending all this money that you've worked hard for and saved and invested and accumulated. So that system of just save and ignore it really doesn't work as you get into retirement. What you'll learn, and we'll talk about this deeper in a few more episodes, headlines get louder. Maybe you listen to your favorite podcast and it gets louder. So we want to make sure that you are in control of all of the decisions that could be made. To go a little bit deeper into this tax control triangle, we talked about $19.2 trillion being in traditional IRAs. A lot of folks have everything, and I can't tell you how common it is. Most folks come in and everything is saved in that 100% taxable corner. And that's not a mistake. We love that tax deduction when we're making the contributions from our 401k or from our income. Accountants will have us do that by design so that we can lower our tax situation in the current year. But really what happens is that just gets kicked down the road to a future year and a future time frame. And all of that noise that you're going to be in a lower tax bracket when you retire is now you start finding out it's a fallacy. You can try, but the longer we wait, the closer we get to age 73 or 75, depending on your age and RMDs, that time frame is gone. So I want to go back into a little bit more detail. Everything in bucket or corner 1, taxable accounts, brokerage, savings, investments that have already taxed, things that you may have inherited that sat over here that are subject to capital gains tax. Whenever we're saving for our retirement, we're using the IRAs. We're kind of taught that this is bad. And I never understood that. Capital gains tax is lower than income tax for most folks. So everything that's sitting over here, yes, it could be taxed if you sell something at a profit, but it's taxed as capital gains, not income. And when those assets pass to your beneficiaries, remember, more times than not, they get a step up in cost basis. So there's no taxable event that's caught when that money passes to your beneficiaries or to your heirs. And then we have bucket two. That's that traditional area. That's traditional 401ks, traditional IRAs, traditional 403bs. Every dollar in here has never been taxed. I know I'm getting a bit repetitive here, but that's by design. I want you to understand everything in that corner has never been taxed. So when it comes out and it's taxed at ordinary income, it's taxed higher than capital gains because it's all ordinary income. So if you look at that and say, I'm going to take a large chunk of money out of here and buy a beach house, you can do that. And I hope you have enough saved in there that you can do that. I'm excited that you get to do that. You should be excited that you can do that. But you know who's even more excited that you get to do that is the U.S. government and the IRS. Because every dollar you pull out of there gets taxed as income and it gets taxed at the highest income potential that you have. So whether that's ordinary income that can push up to 37, which means if you want to pull $500,000 out of there, some of that money is getting taxed at almost 40% for you to go buy that beach house. The IRS and Uncle Sam can't wait for you to go buy that beach house. And then you have that third bracket or that third corner that unfortunately for a lot of folks, especially folks that started saving a long time ago for retirement, may have gotten ignored because that money was after tax. You were taking your income that was already taxed and putting it into a Roth IRA, or you were going to be taxed on your 401k contributions that went into a Roth 401k or a Roth 403b. And that didn't sound like a great deal that year. Well, I already paid taxes on this money. Why am I going to lock it up? I'll just move it over to my brokerage account. It wasn't a terrible decision. However, now that Roth it's time and you're beyond 59 and a half and you want to retire and maybe you do want to buy that beach house, that money would come out without any income tax exposure at all. And that tends to be the smallest bracket or the smallest bucket or smallest corner, excuse me. So most folks have this way out of balance control triangle that is everything over here is taxable. So that pressure continues to build up and that bucket and corner continues to grow. Maybe you don't need it to live on. Maybe you still have a pension. Maybe Social Security is sufficient. And that bucket just continues to grow. And then you get to age 73 or 75. And now it's time. Uncle Sam has been waiting for this moment your whole life that money has to start coming out in the form of required minimum distributions and has to be taxed. And the nightmare that ensues after that is, okay, it's taxes. So what? If I'm making money or I have money and I pay taxes, big deal. But now that may push you into a position where now you have to start paying taxes on Social Security that you didn't have to before. Maybe now your income is high enough because that IRA is substantial and you have to start paying higher Medicare premiums in the form of IRMAA surcharges. So understanding that ballooning tax liability, it's really nice to see that number go up. It's really nice to see that number explode. It's really nice to see that number grow when the market does well or when we're saving more. And Uncle Sam has really enjoyed watching that number grow as well, because now it's time to start forcing the distributions and having you pay more, not just in income taxes, also on Social Security and also for Medicare. You have been driving hard on your career highway for decades. Foot on the gas, eyes straight ahead, on your way to retirement. But when you hit that 5-year stretch before retirement, every pothole seems a little bit deeper. Every traffic jam seems to last a little bit longer. Every construction zone seems to be a little bit more dangerous. And every change in lanes seems to be a bit more aggravating. You are not alone. That is exactly why we designed the navigation formula as our proprietary process at Hoffman Wealth Management, helping you navigate the time before retirement when all of these things start to stack up and these decisions start to seem a little bit more important. As you're listening to the Pre-Retirement Navigated podcast, if there's something that you have a question about, please feel free to book a discovery call with our office. The link is in the show notes, and you can always call and ask any questions you have about something you hear here. Now, back to the Pre-Retirement Navigated podcast. So I want to give you just one more statistic, but before I do that, I know this tax planning stuff isn't fun. Picking an investment seems fun. And a lot of folks don't go through this because this starts to get to be more than a number on a statement. this starts to become returns that you necessarily don't see when you get your annual statement and you see that your assets grew, or maybe if it was a bad year, they went down. It's a lot more tactical. It's a lot more, I don't know what the quite right word is, but it's a lot more work. It's a lot more nuanced than just seeing the return on a statement that can really have an impact. So I'd encourage you to go through this work and understand this, and starting to understand it 4 years out from retirement is important. So that statistic I wanted to mention, when you first hit RMD age, which right now is age 73, it will go to age 75 based on the Secure Act 2.0. But when you first hit age 73, the first divisor at age 73 is 26.5. And what that means is at age 73, you're going to take your amount that's in that right-hand corner, and my right-hand corner, I don't know what corner you drew your triangle on, it can be whichever, but you're going to take that traditional IRA, traditional 401k corner, and whatever's in there, you're going to divide by 26 and a half. So just to give you an idea, for $100,000, that's $3,774. So almost 3.8% of that corner is going to have to come out and then go through your tax scenario. So if you are in the 22% tax bracket, 22% of that distribution is going to be taxed and sent off on the distribution in the form of a tax withholding. So that's based on the IRS Uniform Lifetime Table. On a $1.5 million IRA, that's roughly $56,000 that has to come out in year one. Now, you do get to keep most of that, but that's $56,000 that gets added to your tax scenario just in year one. And every year that divisor changes. Every year that statement balance changes. Just to give you an insight, that statement balance is based on the year end of the year prior. So on December 31st every year, you take a snapshot of what your IRA balance is, or all of the balance of all of your IRAs, and you apply that. Now, that's IRAs, 401ks. This all gets treated differently. Being able to know what you pull from and how much is also a very nuanced conversation. Don't just pull it from one. Some accounts can be aggregated, some cannot. So you want to make sure you're pulling enough and understanding the accounts that you have and where they're located. Again, this is just general investment knowledge and general financial planning information. So you want to make sure that you are considering your individual situation here. Just a quick note about IRMAA surcharges as well. In 2026, the first IRMAA threshold is $109,000 for individuals and $218,000 for married couples. So your RMDs get added to the rest of your income. And if they force you up there beyond those thresholds, you start to have to pay more for Medicare. And that information is it's from the Medicare website and understanding how Medicare works. When you think of a married couple, if both of you are 75 with $1.6 million in combined traditional IRA balances, you're going to have $64,000 in RMDs. That's just what you have to take out. If you have a $45,000 combined Social Security, that's $109,000 before any deductions. And after the standard deduction of $31,500 for joint filing in 2026, it puts you right in the 22% tax bracket. So any other investment income, if you have that brokerage account that we talked about in the first corner that maybe is getting some dividends, it really gets close to pushing you up into the 24% tax bracket. So you want to make sure that you understand all of that. Now, that's a scenario that kind of makes everything abstract real. And we just pulled information from tax brackets and Medicare premiums and from a example that was published in March of 26 on instead.com to use that scenario there. So it's not necessarily how much you have in that bucket. It's not necessarily how much you have as a total nest egg. It's how much of it you get to keep that we start planning for in year 4 and making sure we're pulling from the correct buckets, making sure you're considering a Roth IRA conversion and using those tax brackets. The best philosophy to use there, if you take one thing from this in year 4, you start thinking in tax brackets instead of thinking in income. You start thinking in tax brackets instead of balances so that you can use the tax brackets. And when I say use the tax brackets, one of the most valuable things that we've seen in working with folks over 23 years is using that married filing jointly tax bracket. And the reason I say that is you may have a very comfortable retirement where you don't need much, but you have that corner of the triangle that's ballooning up and starting to get larger. And that married filing jointly tax bracket is very sensitive for a couple of things. One, you may have a lot of room there that you can pull money out ahead of time and pay taxes. And the reason it's so sensitive is, and we've watched it happen, unfortunately, one of you may not be here. And probably the cruelest thing our tax code does is after one of you passes away, making you go back to the single tax bracket. And it's sad enough and it's bad enough that you're grieving and all of the decisions that go into estate settlement. But now the calendar flips and you're no longer able to use that married filing jointly tax status. To us, it's a valuable thing to be thinking about as you are planning what to do with IRA balances, is to use that married filing jointly tax status while you can. Again, it's valuable. It's something that needs to be considered. These are all things to have conversations with your tax advisor or your financial advisor. So it's the right time to start thinking about withdrawal sequence, where you should be pulling money from and when to take advantage of those tax brackets. Maybe we should take from our IRAs earlier because those tax brackets are so sensitive and can be fleeting. Maybe we save that Roth until later. Maybe we should be considering Roth conversions. And a Roth conversion is just taking money that's in that taxable bracket, converting it to a Roth, paying the taxes, still continuing the tax deferred savings. But now you've hopefully paid taxes at a lower rate. You've hopefully paid taxes under your terms, and you've used what's left in those tax brackets while you can. One thing about those, Roth conversions are very sensitive. It can be very dangerous to try to just flip it without understanding what the tax codes are, without understanding what your individual tax situation looks like. It's something that we like to communicate with our clients' accountants or with our own internal tax solution on before we even make the recommendation on how much should be converted. So be careful if it's something that you hear and think, oh, this is a great idea. I read an article or heard a podcast that says I should be doing a Roth conversion. Before you go through that, make sure you're understanding what your tax scenario looks like, because those mechanics are very sensitive, and so is your tax situation. So you want to make sure that you're doing what's in your own best interest, because a conversion is not a win for everybody. It may sound good in theory. It may sound good to save money in taxes, but if you're in an already elevated tax bracket, it can be very expensive conversion. That today versus later conversation needs to be happening, and some projected income goals need to be considered, projected legacy goals, but making sure that you don't just read an article, hear a podcast, see a video and say, I'm doing a Roth conversion is very, very important to understand. Now, the other thing that happens in year 4, we've talked a little bit about it, but if you are retiring before you are eligible for Medicare, you want to make sure 4 years away from that date, you are starting to get prices and understand what that health insurance landscape looks like. Listen, I am looking at health insurance years out at 47 when it comes to my family, when it comes to our team. That is not something that you want to forget about. Retire, have your employer send you the notice that says, hey, your benefits are ending at the end of the month. And then you say to yourself, oh my God, what do I do? Now I'm scrambling, and you're trying to find plans. You're trying to find doctors. You're trying to find out if your doctor is in this plan. You want to make sure you're giving yourself plenty of time to understand the cost, the nuances of health insurance, and they're always and forever changing. Making sure you understand that year 4 is the greatest time to do that, because now you have the time to monitor that. The plan you think you want in year 4 may not be the plan that you want in year 1, but being able to monitor that for networks. I know locally in the Pittsburgh area, those networks are very delicate, and who's in network and who's out network with multiple providers. You want to make sure that you are, that way you're in control. Listen, this is your retirement. This is your health. Other than our health and our money and our family, there aren't many more important things that folks really need to be making decisions about that far in advance. So you want to make sure that you understand what those benefits look like, again, what they're going to cost, what's happening with the costs, if they're going up, They're probably going up. And understanding what those look like, because you don't want to get to that day and say, oh, shoot, I totally forgot about that. Now what do I do? And you're calling your boss asking him, hey, can I come back to work? I forgot about health insurance. So you want to make sure that you think about all of those things. We're going to be talking about all of those situations in a lot greater detail, not just in this year 4 video. I know we're going to be in a lot of conversations when it comes to the tax control triangle. I'm going to try to invite on our internal tax solution from bookkeeper.com and see what they have for us in a way of tax insight. And we're going to talk about the pre-Medicare planning, and we're going to talk about what to do when it comes time to needing to shop for health insurance, because these are all things that aren't just numbers on a statement. They are decisions that have to be made as you approach retirement. So we want to make sure we're talking about them, because that's what this show's about. It is about the 5 years leading up to retirement, whether you're 55, whether you're 60, 65, or even 75. These decisions are things to think about, and we want to make sure that we're talking about them here. That said, if there are any topics that are of interest to you that maybe we have overlooked, please let us know in the show notes, wherever you're listening or watching this podcast, so that we can make sure we address them. We're talking about things that we are seeing every day as we're working with our clients, but I'm sure there's a lot of things that are going on that we're not aware of. So if there's things happening that you have questions about, we would love to bring them on the podcast and talk about them. Also, in the show notes, wherever you're listening, you're going to be able to download our pre-retirement checklist. This is a checklist that's going to let you know where you stand and all of the things that are going on in the 5 years leading up to retirement. So you can go through, check the boxes on things that you've already done, and give you a great barometer on where you stand as you're navigating these 5 years leading up to retirement. As I mentioned in the beginning, also in the show notes, if you do have questions and you want to reach out and schedule a free 30-minute discovery call with our office, I'd encourage you to do so. This is a no obligation phone call, gives us an idea of where you stand in your scenario, and if we can help, gives you a great insight into what our navigation formula looks like and if we could be a fit to help you. So if you do have questions, please click in the show notes and be able to book that discovery call with our office. That's it for this episode of the Pre-Retirement Navigated podcast. Again, hopefully this is information that you're finding insightful. If so, please like or subscribe to catch more episodes. Or if there's somebody that you're thinking of that is in this window, feel free to share this episode with them. But until the next episode, thank you for joining in to the Pre-Retirement Navigated podcast. Will Hoffman offers investment advice through Private Advisor Group, which is a federally registered investment advisor. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult with the appropriate qualified professional prior to making a decision.